Hello students, welcome to my class. This is Professor Vincent Osagai, and this is the presentation of part 2 of chapter 20, Accounting for Pension and Post-Retirement Benefits. We talked about the overview of accounting for pension in part 1, and we left off at different ways of measuring the liability of pension. Let's back off for a minute. In part 1 presentation, we indicated that there are two important questions that we have to answer. Number one, what is the pension obligation that the company should report in the financial statements? And number two, what is the pension expense for the current period? So here we are going to talk about three different ways or three alternative measures of measuring the liability. Like we said, the pension obligation is the deferred compensation obligation it has to its employees for their service under the terms of the pension plan. So what does that mean? Based on the terms or the arrangement between the employees and the company, the pension obligation is the future obligations that the company is going to be stuck with relative to compensating its retirees. So we call that pension obligation. So the compensation obligation is deferred, is in the future. So having said that, here is an important thing that we need to know here in order to understand these different measures of the liability. First of all, we need to understand the term vested benefits. We said that vested benefits are benefits that the employees are entitled to receive even if they quit right now. In other words, they are already vested. They are entitled to receive those benefits even if they leave the company right now. So we call those vested benefits. The second thing you need to know here is the fact that it doesn't matter the approach or the method that we use to measure these obligations or this liability. The fact of the matter is they are all future amounts. Therefore, we have to compute the present value of those future amounts in order to recognize that present value in the financial statement as of now. So, having said that, let's take a look at the three approaches of measuring this liability. The first approach is called the vested benefit obligation. The vested benefit obligation. How do we measure that? That's the first one right here. We said that those are the benefits for vested employees only at their current salary. So we use the current salaries to calculate the benefits for those employees that are vested. So we call that vested benefit obligation. So that is one approach of calculating the liability. Now let's take a look at the second approach. The second approach is calculated based on the current salaries of both the vested employees and the non-vested employees. So we call that accumulated benefit obligation. Obviously, that obligation is higher than the first approach because the first approach simply zero in on calculating the obligations based on current salaries of only employees that are vested. But the accumulated benefit obligation takes into account the vested employees and the non-vested employees using the current salaries. So let's take a look at the next approach, and we call that projected benefit obligation. That the benefits are calculated for both vested and non-vested employees, however, using future salaries. And of course, as you know, future salaries are higher than current salaries. Therefore, the projected benefit obligation obviously is higher than the previous two, than the accumulated benefit obligation and the vested benefit obligation. That is FASB's preference. So again, like I said, either way, we have to calculate the present value of either amount or the amount that we come up with in either approach in order to record the present value in the financial statement. So moving along, let's take a look at recognition of the net funded status of the pension plan. So what do we mean by this? So here, the key word is overfunded and underfunded. We said that the underfunded status is measured as the difference between the fair value of plan assets and the projected benefit obligation. What does that mean? So the company contributes X amount of dollars and send the money to the pension plan administrator. Thousands, millions, or billions of dollars, however the case might be. So at any point in time, of course, that money is not sitting down there as cash because the money is being invested in stocks, bonds, so on and so forth. So at any point in time, the fair value of that plan or the fair value of the assets of that plan versus the projected benefit obligation will give us the overfunded or underfunded status. So let's take a look at an example here. So if the fair value of the plan assets is $50 billion and the projected benefit obligation is $60 billion, then you have $10 billion underfunded pension. So if the fair value of the plan asset is more than the projected benefit obligation, then we have overfunded pension. Now, most of you probably must have heard on the news, especially in the state of Illinois, about our pension situation. For the state of Illinois, it is one of the worst states in the union in terms of their pension being underfunded. Depending on who you talk to, in the state of Illinois, we are looking at about $100 billion underfunded pension plan. In other words, the state of Illinois has $100 billion less than they need to pay retirees when they retire, or to pay the current and future retirees in the future. That is some serious business. Why is that? Because again, remember we talked about two different types of plan. Because the state of Illinois has what we call defined benefit, okay, plan. So the benefit is predetermined, and it is killing the state of Illinois. A lot of states have gotten out of that pension plan because it is very expensive. Let me give you an example. I have a client who is a retired police officer. He is just about what, 58 years old, but he has put in 30 years in service and he retired. Right now he's making a little bit more than $80,000 a year because he's entitled to some crazy 75 to 80% of his salary for the rest of his life. And of course, as you know, more and more people are living longer than ever. So it is very likely the rate at which the state of Illinois is going is not sustainable. Anyhow, I decided to inject that because you must have heard about the state of Illinois pension plan being tremendously underfunded, and it is dragging the state of Illinois economy in negative sense. So moving along, let's take a look at the next objective. Let's take a look at the components of pension expense. So, how do we calculate pension expense? For rent expense, simple, straightforward. For most expenses for that matter, the calculation is very simple, straightforward. So for example, you sign a lease agreement with your landlord. Rent is $10,000 every month. Every month you pay $10,000, rent expense is $10,000. At the end of the year, $120,000 cash close. Same thing with your telephone, so on and so forth. Pension is one of those expenses that is not very straightforward. Take a look at what we have here. We have 5 things have to be taken into consideration, of 5 elements or 5 components that make up pension expense. Number 1, we have a service cost for the year. Number 2, we have interest on liability, assets return on asset, on plant assets, amortization of prior service cost, gain or loss. Those 5 components put together is what make up pension expense. We are going to describe or talk about each a little bit more in detail in a minute. So let's take a look at the first one, service cost. This is actually the pension benefit based on the service that the employees provide at this point. And the actuaries, these are specialists that will help you compute the present value of the benefits attributed by the pension benefit formula to employee service during the current period. And let's take a look at, and that is that the effect on a pension expense is plus. So that is an increase. Now number 2, at this point we need to cut off, and this will be the conclusion of part 2 of the presentation. We are going to take it from here in part 3 of chapter 20 presentation.